I'm actually not even going to try and time it. My idea is take some lifestyle chips off and then run the rest and try and buy the sell-off. I just think it's very difficult to do. It always looks good in theory. It's very difficult to do. And let's say you've grown your $10,000 and it's now $100,000 and the market then falls 80%. The probability of you putting your 100 grand stack back in is about zero, because you'd be worried about losing it. Everyone will be throwing poo at each other online. You know, the US is looking like it's going to arrest everybody in the industry, and you'll never buy it. So just, I really, really, really don't like the idea of, hey, it's just easier. Just sell the top and buy the dip. If you're very new to crypto, just hold the major ones. Try not to observe it, paper trade stuff. Do anything to stop yourself messing this up. You know, I use this "don't fuck this up" thesis, and big thesis is,
don't forget to subscribe, traders. Let's continue with the interview to analyze it later and also comment on some of the most important news of the day.
have 90% just in the majors and 10% you can play around with. But if you're so new, get a feel for the market, understand the volatility, because you think you can deal with the volatility and then you won't be able to, and you'll panic and do the wrong things. Just have your lessons first, learn it carefully. Liquidity is not about passing money from the banking system to individuals. It's a process of debasing the currency by introducing excess currency. We think that the Treasury run down the Treasury General Account. We think the Fed stop QT. We think that the end of the reverse repo gets drained. We think that Fannie Mae probably gets congressional approval to offer equity release mortgages, home equity release mortgages, which could add trillions of dollars. We think that there's kind of either tax stimulus or fiscal spending stimulus to come. We also think that globally, the Japanese might intervene in their currency, selling dollars, which adds dollars into the global system. We also think that most countries will be adding liquidity as well. We think China needs to increase its liquidity. We also think Basel IV is coming next year, which means the banks buying more bonds. So we think there's a lot of sources of liquidity. Another one is commercial real estate. Eventually, if it remains ugly enough, the Fed could create a special purpose vehicle to put all these loans in. We've seen that historically in the past, particularly in the savings and loan crisis in the early 90s. That's another method of liquidity. So there's lots and lots of different avenues, and ones we haven't even covered, that they will look for any answer.
The liquidity in global markets is influenced by a variety of factors that operate in tandem to shape the financial landscape. One of the primary sources of liquidity is the actions taken by treasuries around the world. These actions can include government spending, bond issuance, and other financial maneuvers aimed at ensuring there is sufficient money flowing through the economy. For instance, when a treasury decides to inject funds into the market, it directly impacts the liquidity by increasing the available capital for businesses and consumers alike. In addition to treasury actions, the policies set by the Federal Reserve, particularly in the United States, play a crucial role in determining liquidity levels. The Federal Reserve, through its control over interest rates and other monetary policies, can either tighten or loosen the money supply. Lowering interest rates, for example, encourages borrowing and spending, thereby enhancing liquidity. Conversely, raising rates can have a constraining effect. These policies are often mirrored by central banks in other major economies, creating a ripple effect that influences global liquidity. Global interventions also significantly impact market liquidity. These interventions can take various forms, such as coordinated efforts by multiple countries to stabilize currencies or financial markets during times of economic stress. Such coordinated actions are designed to restore confidence and ensure that liquidity remains adequate across borders. Furthermore, the prospect of fiscal stimuli, including tax cuts or direct financial aid packages, is another critical factor in boosting liquidity. Governments may implement these measures to stimulate economic activity, especially during downturns. By increasing disposable income and encouraging spending, fiscal stimuli can lead to a more dynamic and liquid market environment. Overall, the anticipation of increased liquidity globally is driven by a combination of these measures. Tax cuts, fiscal stimulus packages, and proactive financial policies collectively contribute to a more liquid market. These actions, whether taken independently or in concert, are crucial for maintaining economic stability and fostering growth, making them integral to the ongoing management of global financial systems.
Okay, you need to understand what drives the value of a cryptocurrency. It's driven by Metcalfe's law and network effects. Network effects are the number of users plus the total value transacted on chain, not the number of transactions. So XRP puts through lots of small transactions. It doesn't drive as much as Bitcoin, which puts through lots of lumpy transactions. I've looked at XRP against Metcalfe's law formula, and it always is accurately priced. So either we've not got new users, or in terms of new wallet holders, or the total value transacted is not increasing enough. It's as simple as that. So it really is, it's like it's not being used enough yet to drive it to the next level. Obviously, it has a lot of value because it has a lot of transactions on it, which is why it maintains value, but it doesn't increase value. Do you think it's better to hold until peak cycle, let's say Q4 2025, sell all the crypto for cash, buy the new higher low? This is the same question we've just had. It's like, I don't like that thing. I've tried to do it. I sold out at 2,000 in Bitcoin in 2017, having made a 10x. It went up another 10x, then fell 85%. When I rebought it at 6,500. If I just held the bloody position in the first place, I would have done much better. Don't be too cute. If you need to take lifestyle chips off, please do. But don't think that you can be a hero and top and tail the cycle. It's hard. It's really hard. Even Julian and I, who spent years looking at stuff like ISM, we know the business cycle, still doesn't make it easy to do something like that. So I would rather ride the cycle, take some off when you need to.
The discussion around XRP and Bitcoin transactions brings to light some key differences between the two cryptocurrencies, primarily in terms of transaction volume and value. XRP is designed to handle a high number of small transactions, which contrasts with Bitcoin's tendency to process fewer but larger transactions. This distinction influences the overall value transacted on each network, with Bitcoin often seeing higher transaction values due to its use case as a store of value and investment asset. When evaluating XRP, one might notice its value has been relatively stagnant. This stagnation can be attributed to two main factors: a lack of significant growth in the number of new users and insufficient increase in the value of transactions being processed. Without a steady influx of new participants or a rise in transaction value, XRP's price remains flat. A critical piece of advice for those holding crypto assets is to avoid frequent trading. The volatile nature of cryptocurrency markets can lead to missed opportunities for substantial gains. A personal anecdote underscores this point. An individual recounts selling their holdings too early, missing out on potential profits as the value subsequently surged. This experience highlights the importance of patience and long-term strategy in the often unpredictable world of cryptocurrencies.